The M&G European Inflation-Linked Corporate Bond Fund combines two things. It combines bonds that explicitly pay a rate of interest linked to European inflation, so both your interest and your capital is linked to the inflation rate, and then we bring together with that credit. So we find corporate bonds that we like across the spectrum, using our range of credit analysts and credit specialists to find the sectors we like and the companies we like. We put that together with inflation protection to produce a fund that over the medium term aims to beat European-wide inflation. I think one thing's really important right now, which is that inflation protection is cheap. Over the last few months, people have started worrying about deflation and a breakup of the Eurozone and really bad things happening in the global economy. But that's left inflation-linked government bonds and inflation-linked corporate bonds pricing in only 1% inflation over the next 5 years per year. And that to us looks silly. You know, you have a world where current inflation is 3%, in certain areas of the world 5, 6, 7%, yet the market's pricing in no inflation for the next 5 years. And that to us makes it look like inflation-linked assets as an asset class look really cheap at the moment, so we want to be invested in them. And then within credit, we've also seen a sell-off in corporate bond spreads as people worry about economic growth. And so we like to buy credit risk here. We think that BBB rated companies with spreads of maybe 3% over a government bond look attractive. And we're even seeing value in high yield, because high yield spreads are 10% over government bond yields. And in that environment, you usually make money if you buy a high yield bond at these kind of levels. The reason we think that inflation is potentially a threat is because we don't see any other way out of the global crisis than to print money. Governments have got no ammunition left in terms of fiscal policy. Everyone's worried about their credit ratings and getting downgraded or even defaulting in the case of Greece. So the only weapon left in the armoury of the global policymaker, the politician or the central banker, is to try to create some inflation to reduce the value of overall indebtedness, both in the household sector, the corporate sector, and most importantly, in the government's balance sheet. So we think that if there is a solution to the euro crisis, that solution must be for the ECB to turn on the printing presses and hopefully generate some inflation. Of course, there are risks that they get it wrong in the other direction, and if you think back to the Great Depression of the 1930s, policymakers got it wrong by introducing deflationary policies like letting the banks fail or keeping interest rates high, for instance. I think we're doing the opposite this time round. We realise that we can't survive a world where unemployment's above 10% almost everywhere in the developed world for very long, and that means that policymakers are going to be focused more on getting unemployment down than keeping inflation low. That means money printing, low interest rates, and the risk at least of inflation.